Greg Francfort is the lead restaurant analyst over at Guggenheim Securities. He's with us now for more color on that conversation. Greg, Kate's report talked a little bit and focused more so on that kind of lower income consumer feeling the pain. Is that going to reverberate through not just McDonald's, but other parts of fast food as well?
Yeah, it's clearly been the issue. And I think Chipotle's probably laid it out the clearest. That kind of sub $45,000 household income customer has been pressured for probably 24 months, but that has spread to the 45,000 to 100,000 household income customer. And that makes up 30% of Chipotle's business. But the bottom below 45,000 is only 10%. And so they were feeling it, but it wasn't on enough of their customer base to really make a dent until probably the last 6 to 9 months.
Has there been any indication from your channel checks, your research and analysis that shows that there are places within restaurants right now that are at least relative beneficiaries of some of that weakness in the low-end consumer? Is there a bright light, so to speak, in this kind of consumer sentiment downfall that we've been tracking?
Yeah, I mean, you look at Taco Bell's comps of up 7, you look at McDonald's comping up 2 to 3, Domino's comping up 5. There are places in fast food that are insulated. It actually kind of runs somewhat contrary to the Ozempic thesis that's been out there, that a lot of these fast food companies would really get crushed. And look, restaurant stocks have underperformed the market a ton this year. The S&P is up 16%. Most of the global franchisor businesses are up 3 to 10%. Most of the company-operated fast casual chains, a lot of them are down 40 to 60%. There's been a lot of pressure on the top line, a lot of pressure on the stocks. There has been some bright spots in casual dining, which is that higher income or maybe upper middle income customer, has been performing relatively well and outperforming fast casual, which is a dynamic that we maybe didn't expect as much going into a bit of a softer and choppier restaurant top line environment.
And Greg, we heard just a little bit about some of the labor issues potentially facing Starbucks. How does Starbucks fare price-wise, price to risk-reward perspective-wise, given what we are seeing in terms of a possible labor, at least shortage in the holiday shopping season?
Look, when Brian Niccol came to Starbucks, there was a big premium put into shares. That premium is still somewhat there in the stock, and he has gotten a lot of rope to cut earnings a ton with the hopes that comps and traffic would improve. They have gone positive. They will need to go more positive to recapture the profitability that's been reinvested back into labor. I think the one thing that's interesting and probably really important to call out is this is one of the loosest labor markets and hiring markets for restaurants in 10 years. I think you're going to see wage growth come down a little bit for lower and middle income or for a lot of these restaurant workers. And that may be a margin beneficiary for some of the big restaurant chains, but that's something to watch. It is turnovers down, and it's gotten a lot easier to hire for a lot of these chains.
All right, and because your coverage universe is rather expansive, top pick, given what we are seeing with the consumer over the course of the next 3 to 6 months?
Yeah, we've laid out Texas Roadhouse as a best idea for us. The shares are at $160-ish. There's been some concerns that beef would be inflationary. But this is the chain that when you get cost pressure, they reinvest it into the bottom line, into the guest experience. And so, if you look at a 2027 revenue and you put a 17% recovery margin on the business, it's trading at less than 18 times earnings for a very strong top line, very strong bottom line growth business. We think it's attractive.
All right.